All right, how's it going, everyone? My name is Amos, and it seems like this week, half of my portfolio is going to be reporting their earnings. And the earnings is basically when the company reveals their progress reports for the past 3 months, and they give any updates or modifications for their future, also known as the guidance or the outlook. And as you can see on your screen right now, there's a lot of heavy hitters that are reporting this week. Last week was all about the big banks. This week we have the Mag 7, including Tesla and Google. We also have the healthcare players like Edwards Life Sciences down right here. We have Thermo Fisher Scientific, Centene, and Molina Healthcare. And we also have the military boys like Lockheed Martin, Raytheon, Northrop Grumman, and General Dynamics. And of course, we have the food stocks like Chipotle and Domino's. There's a lot to talk about. And by the way, last week, thank you guys so much for giving me the feedback that you actually like this. So we're going to continue on doing it, and you're going to have to forgive me. I do have some notes in front of me because before we get into talking about the upcoming earnings week, we need to do a quick recap of how last week went and all the different companies that we covered. First and foremost, let's go ahead and talk about Pepsi. After they reported their earnings, they shot up like this. I think in July 16th, they were like 134, 133. Right after their earnings, they went up to like 144, 145. So the gist of it is this. Their sales in North America down, but everywhere else around the world, they're printing cash. So their earnings went like this. They beat on the EPS and revenue expectations. And in terms of their outlook and guidance going on in the future, they're expecting a very low single-digit number, like a 2 to 3% growth rate year over year. And their net income, well, let's talk about it, right? If we jump on over to their income statement, you'll see that it has decreased by a crap ton. Negative 20%, my goodness gracious. And that's because if you scroll up right here, $7.5 billion, trailing 12 months. Fiscal year 2024 was $9.5 billion. And if you scroll up right here, asset write-down of negative $2.5 billion. So the thing to keep in mind is that it's an accounting loss and not an actual cash loss. Because in Q2 of 2025, PepsiCo decided that, hey, the assets that we have right now, initially we thought they were better priced than they actually are. So when they acquired the energy drink brand Rockstar, they bought it for $3.8 billion in 2020. And they also bought this Chinese snack brand called B and Cheery for like $700 million. Is it worth that today? No. So an asset write-down is just the company admitting like, hey, this thing that we bought is not worth as much as we thought. So they have to take a hit on the income statement, and then it will reflect itself in the balance sheet later on. And something else about PepsiCo is later on this year, healthier chips are coming. I think every food company and CPG is being impacted by this, but I don't necessarily think it's going to be a bad thing in the long run, because over in Europe and in Asia, they use better and healthier ingredients already. So their supply chain might be impacted by a little bit, but I think for the consumers, and especially in the long run, I think this is going to be good for them. Because I think there's like a growing movement of people in the US that like boycott PepsiCo because they're like, oh, it has all these weird artificial preservatives in their chips. Now they're not going to have any room to say that, and their arguments are going to go right out the window. And something that I do want to call out is, this is the Q2 2025, their most recent earnings, right? They posted 92 cents this quarter. Look at that, negative 58% year over year. The exact same time period last year, Q2 of 2024, $2.23. What you want to keep in mind is the EPS is basically a precursor of what the dividend is going to be in the growth rate. So if we're talking about something like that decreasing by that much, it does not put a fuzzy feeling in my stomach. Consequently, their payout ratio for their dividend right now is a 99%. Now, first glance, you might be like, dude, their dividend is going to be cut. However, they made the executive decision back in June 6, 2025, to increase the dividend year over year by 6.5%. Let's take a look at it visually. pretty darn perfect and amazing and beautiful. So you might be like, hold on, they can't afford this dividend. Can they? Let's jump on over to their cash flow statement. And we'll take a look at their free cash flow per share is $5.14. Now the dividends paid out is going to be $5.69. I don't know, guys. No matter how you spin it or look at it or evaluate it, this dividend, I don't think it's going to be sustainable. Ooh. However, upon further review, if in fact they do crush it for the rest of this year, Q3 and Q4, the anticipated forecast for their EPS is supposed to be an increase of 11% year over year for the next quarter. And then in Q4, they're anticipating an 84% increase year over year. So if we break it down in an annualized basis, for this year, they're anticipating their earnings per share to be $7.96. So if you scroll back to their dividends, $5.69, whereas the EPS is supposed to be a little under $8. This should be around that 80% mark. So hopefully there's no more setbacks, no more obstacles, and PepsiCo is able to crush it operationally. I hope they do. I am a shareholder of PepsiCo. I've been dollar cost averaging into them as they have been trading sideways since May. Is it a good feeling to see my investment be trading flat? No. However, they have just popped on a pretty good earnings, and I think we're going to start to see a reversal trend and a rebound rally for PepsiCo because, believe it or not, they are one of the best food CPG companies out there. My confidence in them is not lost. I do not think they're going to go bankrupt. I do not think the dividend is going to be cut. We'll see what happens, right? I could be wrong, but I think they're going to be okay. The next company that I want to talk about that reported their earnings last week is Rexford Industrial Realty. This is a REIT that is based in SoCal, and they posted pretty good earnings, and they said that they will meet their guidance for the rest of the year. So I think that is music to Wall Street's ears, because usually in a time of uncertainty with like tariffs, and especially with the REIT industry being smacked in the face with a high interest rate environment, you don't know if the guidance they gave out 6 months or 12 months prior is still going to be the truth. And for Rexford, things are looking good. And what you have to understand about them is past 5 years, their their funds from operations per share, that CAGR is 10% year over year. And their dividend growth rate is 16% year over year. So I don't know if you disagree with me, but I'm pretty bullish on industrial REITs. So when I say industrial REIT, their real estate portfolio consists of warehouses, factories, shipping, conglomerate logistics types of businesses that are located only in SoCal. And you might be like, what? Only in SoCal? Believe it or not, California has, when you put it into comparison with the world, a top 10 GDP. And SoCal is one of the most busiest shipping ports and industrial areas around the world. Yeah, once I found that out, I was like, dude, I got to get into Rexford. And so far, it hasn't been too bad. I bought into them right here at their dip at just under $30 a share. I missed the bottom by 32 cents. But I'm up in the green by, I don't know. I got to pull up my portfolio, but I am up in the green with them, and their dividend is pretty nice. Don't pay attention to this, okay? It's a REIT, so you don't look at their earnings per share, but rather the funds from operations, and it is affordable and it is sustainable. The next company that reported their earnings last week, as you can see on your screen, is Elevance Health. This is an insurance company, and after they reported their earnings, my goodness, they went on a sell-off. They went off a cliff. They went from $3.45 a share down to $2.76. That is pretty darn bad. So what happened? Believe it or not, I actually read their earnings press release, and they smashed their EPS and revenue expectations. However, their leadership said this, and I think every nipple on Wall Street was just dry, because they said we're expecting higher Medicaid costs than anticipated right now. And so they had to pull their guidance for the rest of the year. So consequently, they went on a massive sell-off. And if you're not in the know, people in the US that are on Medicaid, which is basically the government-funded health insurance. If you're from Europe or from Asia, think of it as your health insurance that you have that's paid for by the government. And what's happening is there's a pretty hostile environment. They're trying to decrease, reduce, and I feel like they're on a path of eliminating government funding for health insurance, which I fundamentally disagree with. Because when I think about the weak and the vulnerable population in the US, to take away their health insurance, you're basically giving them a death sentence. And so what's happening is, since that narrative is going around and people are in the know about, hey, my health insurance might not be around forever, or if it is, they're going to reduce my benefits or the amount of procedures or treatments that I can receive in a single calendar year. So consequently, more and more people are anticipating that their funding costs are going to be gone, so they're seeking treatments up front right now. Like if you have a little issue with your toe and you were just pushing it off, now you're going to go to the hospital and seek treatment for it. Oh, you're a little overweight and your blood pressure is just a little icky, you're going to do whatever it takes to get all of your prescriptions, to get all of your treatments, everything figured out right now. And what's really sad is last week, United Health and Centene and all of the other health insurance companies, they also went down because they already confessed, United Health and Centene, that their Medicaid costs are higher than usual, and they both pulled their revenue forecast for the year. But they still went on a sell-off with Elevance, which I think is weird because if United Health were to be punished because their guidance was still intact and their earnings report is coming up and then they cut it, then I could justify the sell-off, but it's usually how it goes. And it's guilty by association, right? Because Elevance is like, oh, our guidance is cut and our future looks a little dark. United Health and everybody else, Humana, Cigna, everybody got punished, even if they already said the same thing that Elevance said 2 months, 3 months prior. And in a different industry, think of it as like AMD going down when Nvidia goes down. It's guilty by association. And this one surprised me, to say the least. Netflix currently trading for about $1,200 a share. After they posted their earnings, they went down by -5%. Let me pull up this chart and show you what's absolutely crazy. So back in 2020, $500 a share. And then at the peak of the pandemic, almost $700 a share. And then they went down on a massive sell-off in 2022 with the rest of the tech stocks like Meta and everything. 187. I was contemplating buying into Netflix back then, but then I was like, you know what? They don't have an economic moat. All they do is a digital streaming service. So I decided not to buy into them, and now look at them, right? Jeez, man, $1,200 a share. But how did their earnings go? They crushed across the board, believe it or not. Thanks to Squid Games, they gave them a shout out in the earnings press release. However, Netflix did tell Wall Street that the cost to do business might be higher than usual for the rest of this year. The production costs, paying your staff, with the tariff uncertainty, they're not too optimistic about having higher margins for the rest of the year. And their financial success, how they beat on their revenue and the EPS, well, it came from currency tailwinds, not actual business growth. So even though on paper, pull it up right here. So even though on paper, their revenue, hold on, this is broken down annually. I want to see it on a quarterly basis. So even though their revenue went up by 15% and the EPS went up by 47%, not all of that is because of organic growth. The US dollar got weaker, which inflated their international revenue. So Wall Street is able to read between the lines and they're like, hold on. So your actual growth is like maybe 3% right here for the revenue and maybe like 15% here, which I still think is really good. But When a company has a trading multiple of like 51, the forward PE is like a 42, the expectations for you cannot mess up anywhere. So when you trade for a premium, the expectations are that you have to be perfect. Any setback, any bad news, any uncertainty, and you will get punished like this, even though you crush the earnings. The end of the day, Netflix is a streaming service, right? They're not making a payment processing app. They're not at the forefront of AI, which to see this kind of valuation, I genuinely disagree with. Right? I think they're far too expensive for what it is they do. I mean, yes, their numbers look really pretty, like the amount they're growing their revenue year over year, but so are the unprofitable AI companies like, I don't want to talk about them, give them a highlight, but like even like SoundHound, right? Look at their revenue growth year over year. And their expectations is non-existent because their net income is negative. But like another one I can talk about is UiPath, right? I mean, look at their growth. So I guess what I'm trying to say is I don't agree with Netflix's valuation, but if they reach these type of numbers from Wall Street, to have a 50 PE, that means Wall Street really likes you, right? And their business model is just a digital streaming service. I still don't think they have an economic moat. And that's why when I think about the landscape, I know the streaming wars is old news. Nobody really cares about that anymore. It's all about AI. Streaming wars is like relevant 5 years ago. But on that line of thought, that's why I'm so bullish about Disney Plus, Apple TV, and even Google's YouTube. Because looking at Netflix and their margins, so check this out, right? Trailing 12 months, they generated $41 billion. The cost to do business, the production costs and everything else, how they generated that money, it cost them $21 billion. All you have to know is the gross profit was $20 billion. It's almost a 50% gross profit. Are you freaking kidding me? So I think the streaming business, if done right, is an amazing business model. And that's why I know there's a lot of people that don't like Disney because of their political agenda and how they just do remakes of all of their old classics and their creativity and magic is out the window. But I am actually pretty bullish about Disney. And Netflix, as you saw earlier, was like a 50 PE. Disney is a freaking 24 and their forward trading multiple is a 20. Not only do they do the streaming service, they also have resorts, parks, and intellectual property for all of their little funky characters like Mickey Mouse. I personally really like the hotel industry. So not only does Disney operate in the hotel industry that is cash flow heavy, they also have a streaming platform and their trading multiple is so low. However, it makes sense because if we take a look at their numbers, 2020 went down by -6%, and that's because they had to close down their parks. See, their growth rate is like a single-digit number year over year. I'm looking at the top line because if the top line is not growing, more often than not, neither will the net income. However, for Disney, what's an interesting case about them is the net income is also known as the bottom line. The profits after paying for all the production and operational costs, what's your leftover, like what goes into the wallet. Look at the growth rate of their bottom line. So, don't sleep on Disney. That's all I'm trying to say. I'm freaking bullish about this company. And I don't know, I kind of regret not buying into them. I should have bought into them. However, I think back in April, I was just going gung-ho and I went all out into Microsoft and Google. Do I regret my decision? Absolutely not. However, if given the opportunity, Walt Disney, did I refer to them as Walmart? I hope I didn't. If Walt Disney goes on a sell-off, for whatever reason, I will be buying into them. Most importantly, all the major banks, as you can see on your screen right now, this is last week, like Goldman Sachs, Bank of America, Citi, Wells Fargo, US Bancorp, they reported their earnings and they revealed that the economy believe it or not, is business as usual, with consumer spending as high as ever, which tells us we are absolutely in a bull market. However, what's interesting is, I don't know why they always do this, but the bank CEOs, they all said that they're scared of the tariff ramifications for the second half of this year. So it was good news, but also a little bit of fear and uncertainty sprinkled in. My apologies, friends and family. I had no idea that the recap was going to take 20 minutes. So I guess going forward, maybe I can make that a separate video itself. But anyways, now let's talk about the stocks that are going to be reporting their earnings this week, July 21st, all the way to Friday. And to kick things off, I think these are ranked by their market cap. And the first one is going to be Verizon Communications. I also think of them as like AT&T, right? Something about Verizon, let's just click and check them out. When I first started investing about 8 years ago, Verizon is one of the stocks that I had invested into. And I learned quickly on that the telecom businesses are value traps. Now, obviously, if you bought into Verizon, I don't know, I guess like right here, at the $30 price point, then you would be like, no, that's fake news. They're amazing because you're sitting on like a 25% gain plus the dividends paid out. Puts you into that, 32% total return. But if you think about it, they just go down and down and down. And I say they're a value trap because on paper, I mean, if you look at their dividend yield, 6%, payout ratio 64%, you might be attracted. You might be like, dude, this is beautiful. But for me, I don't really like the idea of the financials being inconsistent like this, right? Sometimes it goes up, sometimes it goes down, sometimes it goes up, sometimes it goes down. But more importantly, I really don't like their balance sheet. So trailing 12 months, let's take a look at this. $2.2 billion of cash and cash equivalents on hand, pretty good. But how is it in comparison to their debt? So friends and family, check this out. Verizon has $172 billion of debt, of loans, leveraged by $172 billion. Not only that, if we pull out the max, since, I don't know, I guess this website only goes back to, the year 2000 or so. But since then, in the past 25 years, share price appreciation alone, you're down by negative 19%. Does it get any better for AT&T? You might be like, dude, you're out of line calling these a value trap. But let's check this one out too. Financials, just as inconsistent as Verizon. Sometimes it goes up, sometimes it goes down. And when it goes down, it's negative 21%, negative 6%, negative 9%, whatever. Take a look at their balance sheet, their cash situation. Oh, it's a lot better than Verizon. I'll give them that. $6.9 billion of cash and cash equivalents. But what about their debt? $145 billion of debt. Are you freaking kidding me? But maybe their stock price and their performance in the market is better. Let's check that out. Past 1 year, that's pretty amazing. I'll give them credit where credit is due. Past 5 years, wow, this is actually not bad in comparison to Verizon. What about Max? Okay, friends and family, I'm wrong. Maybe AT&T is not so bad. Since 1985, it's a 600% return. So maybe they're not as much of a value trap as Verizon. I take back what I said. But knowing all of that, I'm still not going to be investing into Verizon and AT&T because as I have matured as an investor, I think my priorities have shifted. I think in the beginning, all I looked at, I know this is so stupid for me to even admit, but back then, all I looked at was the dividend profile, the dividend yield, and how high the growth rate and how much dividends I would get. I didn't really understand that you had to look at their free cash flow, their net income, the metrics, their debt, their dividend profile is just a small part of the equation. And that's why I don't really, let me just say I'm not interested in telecoms. Is that fair? Can we move on? Because the one that I do want to talk about is Domino's Pizza. Now, I've mentioned it time and time and again. Domino's is a business that I will always believe in. Their franchise business model just prints cash. Let's take a look at this. Past 1 year, they're down by negative 1.5%. Past 5 years, up by 19%. Max, 3,200%. The cost to do business right now in a high inflationary environment, not really too helpful for the food companies, right? Because there's margins, the cost of pepperoni, dough, cheese, and then you have to think about paying your staff and everything. So I'm guessing, let's take a look at the revenue has been pretty good except fiscal year 2023, but I'm assuming their net income has not been too pretty. Actually, the net income is looking good as well. Okay, well, the dividend profile, 20% dividend growth rate. Are you freaking kidding me? A 1.5% dividend yield. So Domino's is a company where I will always believe in. It's just, do you see those peaks and valleys? But in an overall trend, they are going up. It's just, I really hope the high interest rate and inflationary environment goes away so that my Domino's can succeed once again. I'm in the green with Domino's by I want to say 50, 55%, but we could do better than that. Because according to my intrinsic valuation, I think I had Domino's somewhere like $6.25, $6.50 a share, but obviously they're nowhere near that number. So I will be monitoring them to see how things are going. Their sister, I guess their peer, Papa John's reported the other day, and they crushed. And Papa John's is doing well. So if Papa John's is doing well, then dude, Domino's is going to be doing well. And I'm invested into both of them. But if I had to pick just one, definitely Domino's. And let's see, who else is reporting on Monday? Anything interesting? We have some banks right here. Let's see. No, I would say on Monday, the only thing that I'm going to be paying attention to is Domino's. If for some weird reason they go on a sell-off and they go below $4.20 a share, I might pick up shares. This year alone, back in January, they hit $4.10 a share. I should have dollar cost averaged, but I did not. And I think back in January, what happened in January? Oh yeah, I was being stupid. I bought into a whole bunch of AMD. And let's see. Yeah, I bought into a whole bunch of AMD back in January at 121, 122 a share. And I just sold out of them. In hindsight, I kind of wish I doubled down on Domino's instead. But anyways, let's move on to Tuesday. Let's see if there's anything happening on Tuesday. Oh yeah, Coca-Cola is reporting their earnings. Dude, Coca-Cola, such a high quality business, isn't it? Look at this thing. 5 years is 49% just with the share price appreciation, not taking into account the dividends. Max 26,000%. Now, personally, I'm not invested into Coca-Cola. Me, I'm invested into Keurig Dr. Pepper, which I would argue is a peer, because both of them only do beverages, they only do soda and juices. But I will give props where props is due. I think Coca-Cola is such a high quality and such an amazing business. I mean, yes, they do have some fluke years where their revenue, the top line goes down, but for the most part, if we look at it visually, I mean, this is just too pretty, guys. Hold on, let me take a look at their free cash flow as well before we move on. Ooh, my goodness gracious. They're in a pickle right now. Negative $928 million negative free cash flow. If we say we had Coca-Cola, Philip Morris, love it. I'm invested into Altria. Between Altria and Philip Morris, I think Philip Morris is higher quality. However, you take a look at their valuation, 178. I don't really care about the price of the share. It doesn't mean it's expensive. I look right here to see if it's expensive or not. Trading multiples at 36. Year to date, they're up by 48%. And people keep saying oh, tobacco is a dead industry. But is it really? See, Altria, their trading multiple is a single digit, 9.6. And they're also doing pretty well. So I'm invested into Altria. I'm assuming whatever they say, the market will react with Altria as well. So if Philip Morris is hey, we're crushing it, we're seeing high growth margins, Altria will also benefit from that. And let's see, what else do we have Tuesday? Oh my gosh, it's a military stock, RTX, also known as Raytheon. I think they're pretty high quality, but I think the ship has sailed. So I made that military stocks video, I think 2 times this year. I think I made one in the beginning of the year, like January, and then I made it again back in March. If you bought into them back in January or March when I was talking about Raytheon, you would be up in the green by a crap ton. I saw it coming. I'm telling you, I'm not trying to say that I'm a genie. I always talk about my defeats, my losses, the negativity, but I never really highlight my wins and my gains and my predictions. I kept screaming that the military stocks were undervalued and they're going to outperform the S&P 500. And come to find out, it's exactly what's happening. So RTX is reporting, I think the ship has sailed. I do not think they're a good value at 150. If you bought into them at 130, 120, or even less than $100 a share, congratulations, you're probably very happy. But at 150, I'm not going near them. And the revenue estimation, their market is expecting $20 billion, an increase of 4% year over year. These are very manageable. Yeah, I think they're going to do just fine, especially with all the craziness that's happening around the world. And then Texas Instruments. I remember when I took high school math. This is like back in 2005. We had to get a freaking, what was it called? Like a TI-82, TI-83 calculator, Texas Instruments. And that's what I always associated them with. But little did I look at the expectations. They're anticipating their revenue to grow by 12% year over year. So they have pretty high expectations baked in. Little did I know, Texas Instruments is one of the biggest players right now for the U.S. manufacturing of semiconductor chips. As you can see right there, they manufacture and sell semiconductor chips. Them, TSM, and Intel. So personally, if I was to invest into a chip manufacturer, I wouldn't buy into TSM. Rather, I would buy into Texas Instruments, because check this out. This is a dividend compounder with cheese. Just phenomenal performance in the stock market. Nothing too crazy. Let's see their free cash flow to see if it checks out. $1.58 of free cash flow per share. $5.44 in dividends per year. All right, something's not adding up here. How the heck are they going to be able to finance their freaking dividend? Let's check this out. Their forecasted EPS for this year is going to be $5.62. And I believe the dividend was $5.44. The payout ratio is going to be somewhere around 90-something%. So it does seem like the dividend might not be sustainable, but I think that's because they're using a crap ton of their cash and retained earnings in order to grow the business, because you can't just build a state-of-the-art, well, how do you say that? State-of-the-world, world-class semiconductor, factories without spending some money. So Texas Instruments, and then let's see what else is reporting on that day. Let's see, Tuesday. Intuitive Surgical, Danaher. I actually had a job offer to join Danaher after my MBA back in like 2021, and I think the compensation back then it was like $115. Plus, there was like an end of the year bonus and a signing bonus. I turned them down. Danny here, I like them. There's Chubb, an insurance company, pretty high quality. They were featured in my insurance industry breakdown video. Oh my gosh, Lockheed Martin. Yes, friends and family. I told you. I think when I made the military industry ranking breakdown video, I put them as my number 1. However, they did, since that video was uploaded, they did lose the future contracts for the next generation of fighter jets, the F-47, to Boeing. So I did have to change my opinions on who's number 1 since then. I don't think Lockheed is going to be number 1 anymore. However, I do still think they're a very high quality dividend compounder with cheese. Hold on, let me think about that right now. Based on what I understand about the military landscape and the economics of the Department of Defense and everything, I would argue my number 1 right now would probably be Huntington Ingalls. And then number 2 would be General Dynamics, tied with Raytheon. We just took a look at them, right? RTX. And I think number 3 would be Oshkosh Corporation. So that's what I would say. And I don't want to come off like I'm evil or I'm selfish or I have small feet or that I have a pimple on my forehead. I don't want to come off like that. But between you and me, I genuinely hope there is a sell-off with Lockheed Martin after they report their earnings on Tuesday so that I can finally freaking buy into this company. I really do. And I hope the sell-off is because of something stupid, like the CEO was caught on the kiss cam with the chief HRO officer. Like they got caught kissing, and then it's like, oh, we're gonna have to fire the CEO. I hope it's like a stupid reason as to why they sell off, not because of an operational reason. Because if it's because like, oh, we're losing our contracts, oh, it's because our revenue is going down, then I will hesitate. I don't know if I'm gonna want to buy into them. But based on my understanding of Lockheed Martin and their fundamentals, I think they're gonna crush their earnings, in my opinion. But if there is a market overreaction, I'm going to be buying into them. My personal buy price for them is going to be $420 a share or less. So will that happen? I don't know. I mean, take a look at this visually, right? Their dividend profile, I just think it's magnificent. This is a dividend compounder with Chase. I want to buy into them. The company that I said is number one right now, this is the one that I went balls deep into this year. I went all out. I put thousands of dollars into them at right here, at just under $160 a share. I'm a pretty happy camper with them. Huntington Ingalls is responsible for making destroyers, cruisers, submarines for the United States Navy and Coast Guard. Super bullish about them. They have an economic moat that you would not even believe. And I kept telling the world, these guys are they're absolutely undervalued. Everyone dismissed me. And now they rebounded back to the price that I think they are. They should be valued at $245 to $250. They're above the price that I think they should be. However, I'm still not going to sell out of them because I love them. The thing is, like, there's a philosophy, right? It's like if you trim your winners and you only buy into weeds, your portfolio stock is going to be a hot mess. Sometimes you just got to let your winners keep winning. And that's what I'm going to do with Huntington Ingalls. I'm not going to sell out of them. If for some stupid reason they reach $400 a share in the next 1 month, I will sell them. But if they're anywhere between like $250 to $300, I'm not going to sell. There's another bank. They acquired Discover Finance, Northrop Grumman, another defense contract. I think they're pretty good. I really like the missiles and the drones that they're doing. There's so many people out here hyping up all the different drone meme stocks like Joby Aviation and Archer. What they don't understand is that the defense contractors are light years ahead of them. Okay, so I'm not going anywhere near those $5, $6 penny stocks that are screaming about how their drones are going to change the world, because I would rather invest into Northrop Grumman or Lockheed Martin or General Dynamics. I believe in their drone mission more so than the startups, okay? Let's see. What else is reporting? Railroad company, General Motors. Please do not buy into General Motors. They're a value trap, just like Ford Motors. Packer, they do, what was it, like diesel engines and anything to do with the manufacturing and engineering of the 18-wheel truck parts and engines. They're a pretty darn good company, believe it or not. Anything else? Anything crazy here? Synchrony Financial. You might think they're a bag of ass because they do credit cards dedicated to the department stores like Macy's and JCPenney's, but I actually evaluated them in the bank stocks industry breakdown, and this is a very good company. I know. You might be like, what did you just say? This is a really solid company, friends and family. Synchrony Financial. By the way, how are you guys doing? You guys doing good? Calmaine. Oh yeah, this is egg manufacturer and producer. I think they have the biggest economic moat with eggs in the US. I think they have something like, a 25% of the market share. And on surface glance, they look like an amazing company, right? Let's take a look at this. Year to date, they're up by 2.9%. Past 1 year, okay, there we go. They're up by 61%. And I did look into their numbers, and I decided ultimately not to buy into them. Because number one, this company is predicated upon the price and the production costs of eggs. And as we all know, in the past year and a half, the egg industry as a whole has been in a huge boatload of trouble. Number one, the bird flu. Yeah, something that's potentially out of their control, but if they had more sanitary conditions for the birds to live in, I highly doubt it would have affected the chicken industry as it did. But that unfolded, and so the price of the eggs, supply and demand, there weren't enough eggs to go around the country, so the price of eggs went from like, $1.99 a carton to like $10, right? And then the price should have came back down, right? But it didn't. Cal Maine and some of the other egg producers, they kept the prices artificially inflated to squeeze the margins. So I'm like, man, I don't know about that. And I think they got in a lot of trouble for that. So what I'm trying to say is Cal Maine, I'm going to say it one more time. They're in the business of, grading, packaging, marketing, and selling eggs. Friends and family, I'm not too bullish about the egg industry because what you're seeing right here, these numbers that are really inflated, going from 1.7 billion to 3 billion, is because of the inflated egg prices in the past couple of years. Once inflation comes back down, once the supply shortage comes back into circulation and it's normal again, their revenue, I'm calling it right now, is going to drop down to like 1.5 billion. I'm calling it. This is a company that is going to be very cyclical. They're going to have very high highs and low lows. So I don't want to invest into them. But that's Cal Maine. I looked into them about a month and a half ago, so my brain is a little fuzzy. I don't have any notes in front of me about them. But I remember I dismissed them because I was like, it's too closely associated with a commodity, which is eggs, and I don't like it. It's kind of like an oil and gas company, right? If the price of an oil barrel is very high and there's a shortage of supply of oil, they're going to be crushing. But if there's a lot of oil readily available and the price of the oil barrel is really low, they're not going to be crushing it. And that's why the oil and gas industry, minus Exxon and Chevron and BP, some of the biggest players, the little guys, the middle stream, downstream, or individually the upstream, those stocks go on a massive swings, very volatile. So I'm not interested in anything related to a commodity type of business model. I mean, it makes sense if you are, though. If you buy into them when they're in their absolute low, like that cycle when they're in their valley, it makes sense, right? But for me, I want to buy into something that just slowly and steadily goes up, right? Like their revenue, their net income, their free cash flow, their dividend growth, their stock price, just everything going up slowly. Like that's what I prefer. I don't want something that swings up 100% in a single calendar year and then the next year it goes down by negative 60%. I'm not too much of a fan of that. Okay, so let's see. Let's go to Wednesday. Wednesday, now we're talking about the heavy hitters. Mag 7. We got Google, we got Tesla, okay, I think that's it. But let's start off with Google. I'm going to go with the Class A shares instead of Class C because Class A gives you voting rights. And that's the one you should be buying into. Do not buy into Class C. I mean, there's no real difference. You're basically buying into the company, but if you have the option, go with Class A. I'm so freaking bullish about Google, guys. I went absolutely bonkers buying into them back in April, and I literally thought I was stupid because they were trading flat for quite a while, right? But now they're slowly up in the rebound recovery phase, and there's a lot of stuff that's going against them. There's antitrust conversations saying we're gonna have to break up this company. And for the past, 4 years, 4.5 years, everybody and their ex-wife keeps screaming about how Google's business model is cooked because of AI, meaning people only associate Google with their search line of business. But the fact of the matter is, check this out. If Google is dying, like everyone says, take a look at this. Google search, okay? I don't want to do, let's see if we could do, okay, whatever, we'll do trailing 12 months. Take a look at this. Google search, a company that is supposedly dying to AI, to ChatGPT, to Perplexity, why is it growing at a more aggressive rate year over year since 2023? You riddle me that right now, sir. If ChatGPT is actually taken away from them, why is their search line of business growing? It's because Google has Gemini. They also have AI search related tools. Take a look at this, okay? This is why I think the market is absolutely mispricing Google. Because not only is their Google search line of business growing at a double-digit rate, quarter over quarter, year over year, but so is YouTube, what you're watching this on right now. And this is one of the companies that makes so much freaking money that they even have a business called Other Bets. Stuff that they just blow money on because if it works out, great. If it doesn't, whatever. They have the money and to be able to afford to do that. So for me, I think Google, anything under $189 a share is an absolute buy. For a Mag 7 stock to have a forward trading multiple of just under 20 is an absolute insult, a slap to their face. Okay, I'm gonna say right now, I'm gonna go on record. This is my biggest conviction. I think Google is easily, well, without the antitrust conversation and people on Wall Street not understanding that Google is a part of the tip of the spear when it comes to the AI movement, they should be 220, 250 a share, easily. They're nowhere near that. So for me, I'm going to keep buying shares of Google. You guys do you, I'll do me. And in about like a year or two, I'll report back. I'll be like, remember when I was talking about Google? And I thought some people were saying, oh, Google is cooked. Does this look like the revenue growth of a company that is cooked? Tell me that right now, please. Pause the video, comment. Does it look like a company that is cooked? If it is a has-been and a company on the decline, like Toys R Us or JCPenney's, then why is their revenue amplified at a double-digit rate recently? Why? Anything in their financials and fundamentals is so pretty. Their free cash flow is going from $22.8 billion fiscal year 2018 to $74 billion. You break it down on a per share level, it's just as pretty. You want to look at it visually? Just as pretty. The only thing that I'm not the biggest fan of is their dividend profile, but hey, I'm just thankful they do pay a dividend. A 0.4% dividend yield. You might as well not pay a freaking dividend, but I ain't gonna complain. I will accept my dividend from Google. So if there's any kind of overreaction and they do go on a sell-off after they report their earnings on Wednesday and they go down to like 170, 169, I will be there on the front lines and I will be picking up shares of Google. By the way, how do you feel about Google? I feel like Google is a very polarizing company. I feel like when it comes to like Microsoft, everyone knows Microsoft is amazing. But Google, I feel like there's no one that's neutral. You either think they're going to have a bright future or you think they're a bag of ass. I think Google has a very bright future. So I love them. Tesla, on the other hand, with Elon Musk's involvement in politics, I think he shot himself in the foot. He really did. Let's take a look at it. Their revenue expectation for their earnings is supposed to go down by negative 11%. And their earnings per share, meaning their profits, their bottom line per share, negative 28% is the expectation. The market does not see any growth in this company. So you tell me, why is Tesla trading at a valuation of 188? How does that make any sense from the planet that we live on? How? Look at this. Their revenue growth year over year, 1%, 0.9%. So you tell me, why the heck is their trading multiple a 188? That almost triggers me. That almost offends me. I think Tesla should be like 180 a share, fundamentally, if you do the intrinsic valuation. I think this company, what's carrying them is all the hype, speculation, narrative, and I think Tesla, I don't want to offend you, but I think it's a cult. If you invest into Tesla, you're a part of a cult. Like, you believe in them no matter what. But for me, if given the option, I would absolutely drive a Tesla. But if I had to pick between Tesla and Google, dude, I'm going with Google every single day of the week. I think in the Mag 7, my least favorite is most likely going to be Tesla because they do solar panels and they do cars. Let's not get it wrong. Let's not get it twisted. It's basically just better marketing, but it's still Ford under their hood. It's still GM under the hood. Would I ever buy into a car manufacturing company? No, I would not. So Tesla being a part of the Mag 7 is just hilarious to me. If Tesla has a 188 PE, you tell me, why is Google not at least at a 30? Is that asking for too much? I don't know. Maybe I'm being a little too harsh. Let's move on. Oh, AT&T is reporting as well. So Verizon and AT&T. If you're invested into them, I don't blame you. I definitely do think AT&T is a whole lot better than Verizon, as we just learned. Thermo Fisher Scientific. This, my friends, they're in a whole bag of pickles for the next... How much longer is the current administration? 3.5 years? Because they're basically cutting all the funding, all of the grants, and they're going to have to start firing all of the scientists because the current administration is cutting costs across the board for almost anything related to scientific advancement and research. And that's what this company relies on heavily. And this is a company that was on my watch list for the longest time, but after I found out that their funding is being cut dramatically, and it's just this year, it's going to get worse and worse until 2028. So I'm not buying into them. Yeah, they're going to go... See, the sell-off, I think, is based on the speculation that their numbers are going to be decreased by a lot, but also their future, friends and family, it does not look too promising. I also think Thermo Fisher is the... Let me look this up. Are they the parent company of Nalgene? Nalgene is my most favorite type of water bottle. Yes, they are. But they also do a whole bunch of stuff like, look at this, science solutions, analytical instruments, anything to do with like biopharmacy, biotech, life sciences. They do it all. And their funding is just, yeah, it's not going to be there anymore. I mean, it's still going to be there, but not at the magnitude that it has been in the past. So Thermo Fisher, I guess right now is a good opportunity to buy them while they're on the low. But I would anticipate that you're not going to see much growth until the end of this current administration. Just my 2 cents. Could be wrong. And then we also have Next Era Energy. They're featured in the utility stocks video that I just uploaded. Go watch it. Wow, the expectations is really high for them. They're anticipating a 22% growth rate in their revenue. If they don't meet that number, things are going to look pretty bad for them. And they've been in a pretty deep, smelly situation for the past like year and a half, 2 years. So I really do hope things go up for them. Anything else? Pfizer, the fintech company. We got Moody's, a credit rating business. General Dynamics, a military player. I love them. Chipotle. My goodness gracious. I actually started investing into Chipotle this year, and they were on my watch list since 2018. And I finally got to buy into them 7 years later. And I'm pretty happy with that purchase. Because if you take a look at their numbers, look at that. Just a really beautiful and a pretty thing to see. To grow your numbers at this kind of rate, it's beautiful and it's really consistent, right? And that's what I like to buy into. Companies that are predictable, reliable, and stable. Like Cal-Maine Foods, you'll have years where it goes up by a crap ton and then years where it goes down by a crap ton. I just feel like I don't like that. I like the smooth, steady course. I think 2016 is when they had those food outbreaks or whatever. What was it? Food poisoning. So their net income got shattered, I'm guessing because of legal fees and everything. But yeah, their numbers, I think, look phenomenal. And I wouldn't be surprised if Chipotle initiates a dividend in the near future. Just my 2 cents. Back in 2015, it was 27 cents of free cash flow per share. Now it's $1.08. Yeah, this is a very beautiful company. Sorry. Take a look at their metrics. Average restaurant sales. I guess it is slowing down slightly. Let's see. 10% back in 2023. So I don't know about you, but if Chipotle goes below like $50 a share, I'll probably dollar cost average. I think in the grand scheme of things, like 5 to 10 years. I'm losing steam, by the way. I've been filming for quite a while, getting a little tired here, but in the grand scheme of things, in like 5 to 10 years, I'll be super glad that I picked up shares of Chipotle at $50 when they're trading for like $2.20, $2.25. So not a big deal for me. Are you invested into Chipotle, by the way? I feel like nobody is invested into Chipotle these days. I feel like the hype around this company has left. But I still see, like, under the hood, it's a really pretty engine. Really pretty cold air intake. And they change their oil on time every 3,000 miles. By the way, that's the biggest scam. These days with modern vehicles, unless it's manufactured by one of the crappier brands like Jeep, but for the most part, like a Toyota, Honda, Subaru, one of those good ones, you don't really have to change the oil every 3,000 miles anymore. I think for the most part, when I used to have a car, I use a bicycle to get around town in Japan. I used to change my oil every 5 to 7,000 miles, and my engine was in pristine condition. I think 3,000 is what the car dealerships want you to believe, so that there's more opportunities for them to upsell you. Like you go in there for a simple oil change and then bam, the next thing you know, your headlight is broken. That happened to me, believe it or not, in the Deep South. I was so freaking pissed off. I'm not going to name which region, but my wife and I, we were on a road trip and we decided, not a road trip, we were driving across the country and we decided to do an oil change before going, because we were at like the 5% mark and we still had 95% of the road trip left. And I was like, you know what, let's just change the oil as a margin of safety baked in. Let's do it. And we stopped by this, I guess like a ma and pa auto service place that had really high Yelp reviews. And I know my vehicle inside and out, right? I'm a car guy. Or not anymore. I used to be a car guy. We took it in. I was expecting just a very simple oil change. Next thing you know, my taillights is smashed. And then there was something wrong with like the socket of the wheel bearing or whatever in the axle. And they gave me a bill for like $5,000. I was like, are you freaking kidding me? Come to find out, several of the workers, they did that intentionally because they saw an Asian dude in the Deep South and they're like, all right, let's just drain his pockets. Yeah, that put a really bad taste in my mouth. Like, why is it that an entire industry, we all know, like if you're a dentist, if you're a truck driver, if you are a software developer, why is it that we all understand this one specific industry that has a bunch of crooks or ill-intended people as a whole? I know that's a very judgmental, and I'm being mean when I say that because I know there are good people in it, but why are the majority of the people in that industry, car salesmen, ma and pa auto shops, anything to do with the car industry, why is there so many like mean people trying to take advantage of others? Why is that? Can someone let me know? Because I don't think I've ever had a pleasant experience taking my car to no, actually that's a lie. When I used to live in Los Angeles, I used to take my car to this garage owned by like a Mexican-American family, super honest, very fair prices, and they never smashed my taillights. None of that little shady crap. So I guess that goes to say there's good people in the industry, but for the most part, I've only interacted with crooks. So I don't know. I probably came off as really mean by saying that, but I guess in my 35 years of life, I've just had really bad experiences with taking my car into a shop. I guess like 85% of the time. So yeah, now I'm all like emotional and pissed off just thinking about all the people that tried to take advantage of me over the years. And it's like, so annoying. But anyways, what else we got? We got Waste Connections, which is, believe it or not, I like them more than Republic Services and Waste Management. Because I think Waste Management and Republic Services, they're fighting tooth and nail against one another for the exact same real estate. The growing cities, urban areas. Okay, and it makes sense. Per capita in the density, they can make more revenue. Waste Connections, their business model is different. They're trying to capitalize and serve the areas of the U.S. that don't have waste management or Republic Services. So I'm talking about the rural areas. I'm talking about like the national parks. I'm talking about the areas that require specialty disposal services. I like this company. And as you can see, they're slowly going on this dip. If they go any further on a sell-off, I'm in there. I'm buying into them. I'm telling you right now. I really like it. Because trash and the utilities, I'm going to make this video one day, I promise. What are the buy and hold forever stocks? The key word here being forever, because most stocks you got to reevaluate every 5 years, right? Because their business model might not be intact. Trash companies will never go away. We are always going to need to dispose of our garbage. Do you really think you're going to start composting your baby's diapers? Do you really think you're going to not want to have someone pick up your trash every Tuesday and Thursday for you? No. So trash, very stable and reliable industry that I want to invest into. And there's Crown Castle. Oh my gosh. I haven't talked about them or looked at them in so long, and they're still 105. How sad is this? I am. So it's a REIT in the business of renting out telephone and cell towers. And I think they just got rid of their cable network or whatever. I don't know. I haven't been keeping up with them ever since I sold out of them. I sold out of them at 105 a share. I had bought into them when they were around, I think like right here, under around $88, $89 a share was my cost basis. And once they hit 105 this year, I signed out of it back in March. I was like, I'm out. I don't really like their future. I don't like what I'm seeing. I don't like what I'm hearing. I think the better cell tower REIT, this might offend you. I'm so sorry. It's their competitor. American Tower is head over shoulders so much better than Crown Castle. Because American Tower is not only operating in the US, but they're doing it internationally, right? With Crown Castle, they're only focusing on the US population. And when you think about the trajectory of the internet business, there's so much disruption happening, right? I think Starlink and satellite type of internet providers and the fiber network, I'm bullish about that. I'm not as bullish towards the cell towers. I think maybe like 5 years ago, my investing thesis was that with 5G ramping up, everyone is going to start using their cell mobile network for internet instead of fiber. And come to find out, that's just not the case, because with their RF and their frequency range, it's really short, believe it or not. You got to be pretty darn close to a cell tower to get that 5G. Whereas with your fiber network, if you connect it to a Wi-Fi, your whole house is covered and you'll have super fast internet speeds. I guess all I'm trying to say is I don't believe in the future for Crown Castle. So I sold out of them at 105, and they're still at 105. So it's just, I feel bad. It's like I really want them to succeed, but it's just not happening. What else? Is this Graco, the baby products manufacturer? No, it's not. What do they do? It looks like they do chemicals. Yeah, they do paint and all that. Okay, never mind. That was Graco. I'm having my first kid this year, so I'm doing a lot of like baby shopping and looking at stuff. And Graco is a brand that I see a lot, but I guess it's not the baby one. Hasbro, the toy manufacturer. This is the company that I learned how to do accounting with in my MBA. So for the entire I forget, 16, 18 weeks of that course, we looked at Hasbro inside and out, at all of their financials, all of their everything, to figure out how to understand a publicly traded company. And this is a company where when I was taking the accounting class for my MBA, I really liked. I was like, dude, I wouldn't mind buying into them. But I think they just keep shooting themselves in the foot again and again and again. I think a few years ago, they had this controversy with Magic the Gathering. Something happened and they angered their customer base. And when you think about the tariff implications and everything, importing their toys from China, I don't know. But hey, they're up by 39% this year, so what do I know? But if we jump on over to their financials and we take a look at this, do you think this is smooth, steady, and reliable? I don't know about you, but I think that's the complete opposite. I think their revenue is pretty much flat. 2015 was $4.4 billion. Now it's $4.2 billion. All that time has passed and your revenue is less than 2018. I just don't understand how the heck they're up by 39% for a company with crappy fundamentals like this. Dividend payout ratio is pretty darn high. And by the way, I want to make one more remark in regards to that car industry thing I said. If there is an honest person in the car industry, you're an honest mechanic, you're an honest dealership or whatever, you would have my business. I would actually pay above the market price if I can work with someone that is trustworthy, not racist, and is not predatory, right? Because I think with my past experiences of, getting screwed over left and right, not my favorite hobby, right? I don't like getting screwed over. I think if there is Like in my local area, if I know you are an honest car person, I will recommend my family and friends to you. Just to show you that I'm not like completely against the idea of people in the car industry. It's just, yeah. I think it just goes to show, it doesn't matter what line of business you are in. If you're just honest and you try to take care of the person in front of you and you have their best interests and you're trying to help them out, I think that's the way to have a successful operation. I feel like if your main mode to garner profits is to screw people, is to scam people, is to manipulate people, you're just not a good person. And I feel like eventually it'll catch up to you. What you do in the dark eventually comes to light. So, I don't know. Look at me talking as if this is a freaking John Wick episode. By the way, John Wick, dude, you can call me basic, you can call me stupid, but I think John Wick is one of the best movie franchises. So on surface level, like, yeah, it's just a bunch of action, but I actually really like the storyline. I really like it. And I keep saying it, they gotta make a movie about how he became John Wick. You know how they always talk about, this is a spoiler alert, turn off if you have never seen John Wick. I'm giving you the chance. 3, 2, 1. You know how in the movie they talk about, oh, John Wick, I've personally seen him unalive someone with a pencil at a bar, right? Like, I want them to make a movie showing that scene, showing how he became John Wick, his training, what he went through, his early missions. I want to see a movie like that. Anyways, anything else? Oh, I thought it was Church and Dwight, the CPG, but it's not. This is a company that only makes frozen potato products, Lamb & Weston, like French fries, tater tots, hash browns for the restaurant industry. To be honest with you, I don't know why you would ever want to invest into Lamb Weston. Not even trying to be rude, it just doesn't make sense to my pea brain. And then there's another food, not a food. All right, we're going to have to sign out of here in a little bit. I just called Mattel food. I actually have 2 MBA friends who work here. I think they're like directors in finance and marketing, respectively. Mattel is the peer and the competitor to Hasbro. They make toys like, is it Hot Wheels? Yeah, Hot Wheels and Barbie. And then let's see what else we got. Robert Half, an employee staffing agency, headhunter. Absolutely not. We got, Travel and Leisure. They're in the business of, trying to remember from the top of my head before I tap out. I think they're in the business of selling timeshares. Let me see if I was right. Yes, sir. Vacation ownership. And they used to be a part of a hotel brand, but they did a spinoff. Let me see who they used to be a part of. I think it was not Marriott. Was it Hilton? Let me see who they used to be a part of. This is basically what I do on Sundays, by the way, before the market opens. I just do a ton of research like this. Spinoff. Who did they? Oh, Wyndham Worldwide. I just made a video about them. How embarrassing. And Wyndham is a company that I would definitely buy into. It's a franchise hotel business model, prints cash. And this is their equivalent in timeshares and vacation properties. So let's see. But between the two, I would go with Wyndham. Anything else? There's a lot of companies reporting. What is this, Wednesday or Thursday? We're still on Wednesday? Are you freaking kidding me? I guess next time I'll do the recap as a separate video and then this one as its own dedicated video. Let's see. Do we have anything? Oh my gosh, now we're in the $500 million market cap territory. These are small, micro cap companies where they're a lot more volatile because of their valuation and shares outstanding. Okay, Thursday, you thought Wednesday was a lot, 121 companies. Thursday, we got 151. Honeywell, I love this company. I think of them as like the competitor and peer to 3M. 3M is a company that I do own. They just posted their earnings on Friday. Let me see how things went, actually. This might be a good time to Good to have to see how things went. Oh, they went down by negative 3.6% after they reported their earnings. So I'm guessing things didn't go too hot. But I thought they beat their earnings expectations and everything. Let's check it out. So break it down on a quarterly basis, Q2. So their revenue went up by 1.4%. Their EPS went down by negative 35%. 3M is probably one of my better performers in my market. I bought into them in their lows right here. At the end of 2023, at under $90 a share. Since then, I'm a pretty happy camper. I'll stay put. I don't think I'm going to sell out of them. I actually like investing into the industrials, like 3M, the railroads and everything. But at the right price point, I don't mind selling out of them as well. If I had to pick between 3M and Honeywell, I would go with Honeywell every single day of the week. And let's see, Union Pacific, a railroad company. Intel, $100 billion market. How is Intel doing? I'm going to go ahead and assume they're about $20 a share. Let me see what's going on. 23, color me riddled. Wow, they're actually up by 15% this year? That's pretty wild. Their financials are probably the ugliest thing you will see here today, friends and family. 2021 is $79 billion. Now their revenue is $53 billion. You want to see it get worse? I'll show you. Their net income is negative $19 billion. So they don't even have profits. They don't even have a bottom line. It's pretty terrible. And I don't want to petrify you, but I'll show you their free cash flow situation. Negative $12.8 billion of free cash flow. And it's because they're currently spending all of their money on trying to replace TSM in Taiwan. But I don't think that's going to come to fruition because TSM is opening up shop here in the US, and TSM is light years better and ahead of Intel. I get it. Intel 20 years from now, I doubt they'll be gone. But I just feel like there's better use of your capital. Because think about opportunity cost, right? You buy into Intel and you have to wait 10 years for it to be a compounder. It's just like, it's not my cup of tea. There's NASDAQ, a company that I am invested into. Obviously, as the name might imply, they're in charge of the NASDAQ. Other platform is the New York Stock Exchange. Those are the two platforms where we trade stocks here in the US. And they also do financial services. And every single time you buy the QQQ, the NASDAQ 100, or any ETFs or stocks that are on the NASDAQ, traded on NASDAQ, they get royalty fees. Love their business model. They were one of my first videos that I uploaded onto this channel, and I bought into them at around $52, $51 a share. Yeah, I'm a pretty happy camper, and they pay a dividend, and it grows at a rate of 10% year over year. And I'll stand by this. I still think they're the better alternative to S&P Global. I think they're both high quality, but I think NASDAQ is the way better deal. The way better deal in the brighter future, in my opinion. So there's NASDAQ. There's a military company right here, L3 Harris. Oh, so Keurig Dr. Pepper is reporting alongside with Coca-Cola. So I think, I did the calculation a hot minute ago, but I think their intrinsic valuation was like $38 a share. So at $33.50, I still do think they're a little cheap, but obviously the upside, not too much. And it's a company that I don't plan on selling anytime soon. So whether things go good or bad, I'm still going to hold on to them. I'm more bullish about, so here's the thing. I think Coca-Cola leading up to this point, magnificent history. But if we're talking about 2030, the year 2035 and beyond, I'm more bullish about Keurig Dr. Pepper than I am with Coca-Cola. And let's see. Edwards Life Sciences, they do stuff with like heart valves, anything to do with the heart. Like, what is it? What is that industry? Oh, medical device stuff. That's what they do. However, I think their economic moat is eroding right now because their competition is now making better valves for the heart, and the Chinese versions of it are just as good as well. So this one, I probably would not go near. Oh my gosh, Tractor Supply Co. I said it before, but if it's between Home Depot and Lowe's, I wouldn't invest into either one of them. I would rather invest into Tractor Supply Co. This is a really solid company that not many people know about. And I think it's because they usually only open up shop in rural America, but the prices at Tractor Supply Co. so much better than Home Depot and Lowe's. If you know, you know. You got Southwest, LabCorp. This is the company that does like the year analysis with your pee. Because if you're onboarding to a new job, they don't want to see that you piss hot for something weird or exotic. Dow, Comfort, I'm pretty sure this is HVAC. And I'm working on the HVAC industry breakdown video because I think it's correlated with the growth of data centers. This is one of the companies that's going to be featured in that video. Just a heads up. Decker's Outdoors. Isn't that the parent company of Hoka Ona Ona? I could be wrong. Let me see. Hoka, yes. 101. I just feel bad for all of the different retail apparel and shoe companies. Like Lululemon, Nike, they're all getting hammered right now. Yeah, negative 49%. You want to see something pretty ugly? Lululemon. They do like athleisure. Is that what it's called? Athletic leisure wear where it's comfortable but it looks bougie. And apparently it's trending right now with the black community. I think the black community is now turning their backs on Nike and they're going all out on Lululemon. Which historically, Lululemon is what your wife would wear to a Pilates class. So I think it's kind of funny their demographics is shifting. But you want to see something ugly? My goodness gracious, friends and family. And we could pull up Nike as well. And that's why I keep saying that I wouldn't invest into a clothing brand. Because what's hot today is not going to be hot in 5 years. It's such a cutthroat industry that it just doesn't make sense for me to invest into Nike, Adidas, or American Eagle, or Abercrombie & Fitch. It just doesn't make sense. I would rather buy the store that sells their stuff, like Amazon or Dick's Sporting Goods. Does that make sense? Because it doesn't matter which brand is hot, they're still going to make money because they're selling whatever is hot. But if you're Nike and you're considered old news, then you're going to suffer. Right? I don't know. That's just how my pea brain operates. I think it makes sense, but it might not make sense. And let's see if there's anything else that's crazy. There's a lot of companies reporting. My goodness gracious. And now we're almost in the small cap territory. And now we're in the micro caps. Anything? I'm not seeing anything that stands out, guys. All right, let's do Friday, and then we'll wrap up this video. 46 companies on Friday, July the 25th. Charter Communications, they're also in the same line of business as AT&T and Verizon, but I think their footprint is a lot smaller. Oil and gas, Phillips 66, Ryanair, the budget airlines in Europe. Centene, health insurance. Now, yeah, they're going through a pickle right now. Oh my goodness. But so is the rest of the health insurance industry. And I think I talked about it in the intro of this video. I think right now, if you are a value investor, I'll be honest, I think the health insurance industry makes a ton of sense. Maybe not for the next 3 months. If you buy into them, they might go even lower or they'll trade flat. It might not feel good. But if you can stomach the volatility, I think in the next 10 years, I don't think that the health insurance stocks are that bad of a deal right now, especially with their current valuations of having a single digit PE when they usually have a PE of 30. It just makes sense. That's not financial advice. Please don't think of it that way. It's just, as a value investor myself, I think the health insurance stocks are easy for me to buy into. And then Booz Allen Hamilton. I've been trying to buy into this company for a hot minute, but the opportunity has not come for me. They basically do consulting services for the government. So if the government can't install and ramp up some kind of website platform or enterprise system, these guys will come in, open up shop for the Department of Transportation or Department of Defense and get it up and running. So I like where they're trying to go towards. They're trying to become a tech client services company rather than being the traditional consulting business model. But I've been creeping on the consulting forums, and there's been a lot of layoffs happening for Booz Allen. They're cutting the consultants left and right. And when it comes to a consulting company, the consultants, the number of employees you have, are basically the amount of revenue that you can generate, like the potential revenue. And to be cutting so many employees, not the greatest sign, but I think their numbers back up why I am bullish towards them. I thought their valuation would be at least 22 or 23 PE, but my goodness, it's still in the teens, 15 and 17. Basically, I've been trying to buy into them for a while at under $100 a share, but I don't know, that opportunity has not really, I guess it did come back in June. I should have snagged some shares. I should have done it. They hit 98, 95 back in June. I guess you live and you learn. That was about a month ago. So I think these two companies I'll be paying attention to on Friday. If Booz Allen, for some strange reason, goes on a sell-off, I will be buying into them because they already gave the worst news at their last earnings report. They're like, hey, our guidance for the rest of the year doesn't look too hot. Our services have been reduced, and the market punished the living crap out of them. If they do, in fact, go below 100, I think this time I will snag shares. And then there's a utility company that's featured in my utility industry breakdown video, Portland General Electric. Other than that, friends and family, I think that just about wraps up this video. By the way, I love the feedback that you guys gave me last week, and that's why we continued this series for this week. So thanks for commenting. Thanks for engaging with me, and thanks for supporting a small YouTuber like me. I genuinely appreciate it, right? I'm not out here getting 100,000 views. I don't even have 10,000 subscribers, for crying out loud. So when you comment or you click like on a video, dude, I really appreciate it. So with that said, I love you guys. Good luck, stay safe, and I'll talk to you next time. See ya.